Welcome to Sticky Ventures Podcast, where Mike and Ted dig into the obvious things people ignore to help you build amazing startups.
Hey, everybody. Welcome back to the Sticky Ventures podcast. For those of you who don't know, we build and back ventures here with our chairman, Ted. And in our first episode, we introduced Ted and myself and what we call internally Ted's Maxims. And we use this as a springboard for the conversation about how venture studios like Sticky can help founders take their ideas from concept into a functioning venture. Today, we're going to be building on that idea and that discussion into another one of the maxims, which is raise money last, not first. A lot of people have a lot of different ideas. I'd like to welcome back my co-host, Ted Yang, to talk a little bit more about this. So welcome, Ted.
Hey, thanks, Mike. Good to be back. Just also, we've gotten some feedback from our last episode and just want to let people know that we've heard that. We definitely want to get some guests on here. So if you're actually interested in being a guest here, more on that later, but certainly reach out to us. And the other thing that I heard was that you want to hear more about some of the specific stories and startups that we work with, which is great. We're trying to keep these pretty short, but we'll be expanding more of that war story stuff going forward.
Certainly, more to come. Okay, so on the topic of fundraising, I think that we have a pretty, I would say, well-defined perspective on fundraising, and I think you often stress the importance of, as we said, like raising money last, not first. Not putting the cart before the horse, kind of thing, which some founders can tend to do. Really trying to put in that sweat equity at bringing in even some really basic friends and family money before going and trying to raise money from outside investors. So can you explain the importance of this approach for early stage entrepreneurs, especially those who maybe don't have a lot of track record under their belt, and what the benefits of building a strong foundation on sweat equity and friends and family money are, obviously, before going out and raising that external capital?
Yeah, I think raising money last, not first is not, it's probably something people talk about a lot more right now, given that money is tight out there. Maybe it was a little bit more controversial in the past. Now it's people are forced to follow this maxim a little bit more. But even when times were rich and there was a lot of venture money floating around or a lot of seed money floating around, this is something that I've always internalized in the companies that I'm involved with. And then whenever I'm advising other people, is something that I like to stress. And what I mean by this is, to be clear, here we're talking about once the company is actually operating, right? So when you are planning and thinking about what you want to do, of course, you should anticipate and build together your plan based upon what the funding you might need and how that path might go. And then now we're talking about, okay, now I'm going to do this thing. Now I've started to do this thing. How do I start to do this thing? And so I think what's important is that you understand really both the scale and scope of your idea and how you want to approach this, right? Now, I think most everyone has heard, okay, I need to focus on things with $100 billion TAM before I'm even going to even do this, because otherwise I'm not going to get very money. And I've plenty of other podcasts will tell you, okay, make sure that if your idea is too small, that you go and you talk about all the different adjacencies and how you're going to conquer the world and everything's going to be a unicorn. I think part of the fundamental here is understanding that that's a path, right? And implied in a lot of those paths is essentially a horse race stage where you're just going to need a lot of capital. And if that's the category of idea that you're going to have, maybe you don't want to follow this advice, but I think you still should. And I'll go into more of that later. Any other idea, and by this, look, in this economy, in capitalism in general, there are plenty of great ways to make profits out there, right? And there's no reason why some of those things, those ideas can't be funded. And by this, I mean with external capital, but you just have to be really clear about what the opportunity is and how that works. And so example, again, you want to found a unicorn, at some point you're going to be running flat out. You need to raise a ton of money, right, to support a hyper growth stage. And that means a particular type of ride. It means a particular type of investment strategy. And it means a particular case of where you want to go and how that goes. And if you're looking at something else, maybe $100 million opportunity, $10 million opportunity, maybe that will then dictate your funding strategy. And so all of this though is to me, another reason why you raise money last, right? So it's important to really understand what your idea is, what your company is, get out there, and then put as much sweat and friends and family funding that you can into it. And within reason, right? Like I'm not sitting here saying sell your house and that kind of stuff, but you got to understand what's right for you. I personally believe that if you put yourself and your family at risk, you're not going to be able to do very well as an entrepreneur. Maybe other people feel differently. Love to hear from you if you think that's true. But I'm not a believer. I'm not a believer in living literally forcing people to go on the knife's edge before they do their best work. I think that people need to take care of themselves and their families first. But anyhow, specifically into this kind of, let's call it bootstrapping approach, you know, obviously this will improve your valuations. Okay. I don't think I need to say that to anyone in this audience, but I think there's more to it than that. I think that when you go and you and your partners put in the sweat and you put in let's call it the social capital necessary to convince your friends and family to come in with you when you do have those out-of-pocket costs and or you're dipping into your own savings or whatever, when you have those hard costs that you have to spend, right? That level of commitment, that level of understanding is absolutely appreciated in ways that maybe not even reflected in valuation, right? It's certainly important, I think, to test out a partnership, and knowing who you're in the boat with, as we said last time, and we'll keep saying again, is super important. It's certainly important in terms of taking some of those first stumbling steps without, in my mind, really being beholden to other people. Now, of course, someone will chime in here and be like, listen, if I take money from Uncle Jimmy, he's gonna be really pissed if that money disappears. I hear you, right? And I don't want to mess up your Thanksgiving. But what I'm saying is it's still a little bit different than when you're signing on the dotted line with OPM, right? Other people's money. That's a totally different.
Yeah, I would add from my experience being a very young entrepreneur and raising some of that kind of money, mostly friends and family money. I would say we ultimately got to the point where we got some angels, but a lot of money came from the team, from friends and family of the team in our in that very first venture. And I would say that there's a certain amount of validation that comes with that, I would say, right? From the perspective of an investor now, like if I were to talk to an entrepreneur and they were to tell me that they hadn't raised any money from friends and family, unless it was really a situation where they really couldn't. Obviously, I think we have to be cognizant of the fact that there are people that come from different economic backgrounds. And so not everybody has the same opportunity to be able to get access to that kind of capital. But if somebody came to me and like never really tried, or their friends and family wouldn't invest even if they could, that's not really a ringing endorsement, right? If you're an entrepreneur and your own friends and family aren't willing to write you a check for a little bit of money that maybe makes them a little bit uncomfortable, then why would somebody who does this for a living write a similar check? Granted, more money, but also money that they want returns on, not just that they want paid back the principal.
Yeah, I completely agree. I think a lot of cases people are not asking themselves the hard questions. And there's another topic here, which maybe is worth going to a little bit, which is value in sweat versus cash. And people have a lot of different viewpoints on this. I will say though, that the one thing that destroys partnerships more is when people are not aligned with the value of each person's sweat. Right. And a lot of times that disconnect happens because people are in totally different life situations, right? One person might be whatever investment banker and they go, listen, man, like my time is worth whatever, $300 an hour, like I make from JP Morgan or whatever. And someone else, yeah, I'm a coder and I can go right now on wherever I'm working, go get $200 an hour or something like that. Like, okay. Well, I'm not saying there's a right or wrong answer. I'm saying you get clear about that value of that sweat equity and then the cash contributions that you all make. Again, I'm in favor of everybody making a cash contribution, no matter how small. If you're going to found a company, I've been in companies where that has not been the case. And that is, to me, a perennial sticking point. Even though some person may put in more sweat, cash is king, even amongst partners. When we expand this horizon to talk about the next step and getting outside your friends and family, getting the angels, that even more, right? Even more. So I think that it's absolutely important for the founders to be crystal clear amongst each other, putting in the sweat, putting in the work, and putting in the cash, whether themselves or from friends or family, and how that works, right? And making that clear. Because if that stuff is not clear and it's not, again, it's a good time to test that stuff, to get that stuff really nailed and make sure you're on the same page before you go and take someone else's money. And when you take someone else's money, you have a legal liability that's completely different. You have a level of scrutiny that's completely different. And you just a day-to-day operation that's just completely different and needs to be completely different. So that's like all these other factors aside, the kind of, I use the analogy of kind of the starting gun. There are many different starting guns that happen when you do a startup. One is when you all decide to, whatever, allocate those hours or quit your jobs to go do it. And then there's something else happens that first time you take in external money. So those are the big inflection.
Cool. All right, I would say there's another component of this that you mentioned as you were talking about being unbeholden to outside investors. And this sort of comes back to this idea that at the core of it is something we've talked about, like entrepreneurs and investors are never fully aligned, right? Especially external stakeholders. So it's one thing when it's a couple of people getting together and it's like, all right, let's like put in some sweat equity. We'll throw in some money to fund marketing or something like that and test this out. But then when it comes time to going out to the next level, right? Someone who might come talk to us, someone who might go talk to angels, talk to other investors, even institutional ones. How is it that changes things? How is it that entrepreneurs can manage? What is the nature of that misalignment, as you put it, and how can entrepreneurs manage that situation?
Sure. So I think fundamentally, the most important thing to understand is that at whether it's an angel or a professional investor, in my mind, there's really not that much of a difference. When people are writing you checks, that is not tied to their day-to-day livelihood, right? That is a different thing, right? They are fundamentally looking at that as the investment, and they want a return. And one of the most important things to understand about companies and startups and what have you, and especially if you're chasing to be a unicorn, is the cash flow situation of an investor. If you're an investor, there are plenty of other resources for this, so we don't have to go into too much detail. You've got choices as to where you put that money, right? So right now you can put that in a bank account, get 4% or whatever. You can put it in CDs, you can put it in treasuries, you can put it in the stock market, and you can put it under your bed, right? And each of those has a different risk reward return. Professional money is a lot more clear about this. Angel money, a little less clear, but the reality of it is everyone is looking for a return that's above what else they could get in the market. And then, of course, because startups are so much riskier, they're looking for even more return on top of that. So a lot of times you hear, okay, 10x return or what have you. That's a separate podcast. We don't need to go into that right now. But understand that an investor wants to make a very healthy return for the risk represented by your pretty much unknown, and certainly unknown to the company, unknown to the market company. And
Yeah.
that right there is a misalignment because your goals are not met, right? So your goals may include plenty of other things, including, hey, even if this fails, I want to be able to do my next startup. I want to be able to be a consultant, or I want to be able to go back to my boss and get my job back. I want to pay for my family, support my family, all sorts of different things, right? So that's one big way. The other thing is when we talk about returns for investors, they don't get returns until there are distributions of profit or until there's an exit. And in many cases, again, for the hyper growth type level companies, they don't distribute profits, right? So investors are not employees. So they are not going to get paid by the later stage monies or profits, revenues, and what have you, that you as an employee / founder will be. So again, that's another case where you're talking about misalignment. So that's nice in theory. Let's talk about what that means, right? What that means is when you're making decisions about long-term, short-term health of your company, in many cases, your early investors, certainly professional money, are going to be on your board. And in many cases, you're going to want them on your board because they've got the experience. But in many cases, you're going to be talking a bit of a different language. So they're thinking, hey, how are these guys not going to blow my money? Number one, how are they not going to fall flat on their face? And then how are they going to get me the return I need? So again, for many venture capitalists, especially for later stage money, this isn't about a little return. It's a lot return. And they're willing to take that risk with you because if they wanted a little return, they would have gone somewhere else. So that I've seen that misalignment play out in my own companies. Let's call it boardroom fights, in some cases resulting in people leaving, in not good outcomes, let's say, because fundamental misalignment. Now, don't get me wrong. There's a little bit of this that's unavoidable, right? Obviously, again, it's your living at stake. It's not the VC's living at stake.
That I think that's a huge one that a lot of people, a lot of founders forget about. The definition of success to your investors and the definition of success to some founders is not the same. And that's why it's so like vitally important that you're aligned on the definition of success.
Absolutely.
I can go on, but I won't.
In the short run, medium run, and long run, all of these things, what does it mean to be successful? And I'm not even necessarily talking about metrics. This is more like holistically, what does success mean? And another way I look at things is hey, you and your founders might be cool if the company throws off, let's say, $1 million in profit that then you can distribute. And that people are like, hey, that's really cool, man. I can get that Tesla I always wanted or whatever. And your VC is going to be like, or your angel is going to be like, dude, I don't need 100 grand. That's why I gave you 100 grand. Right? I need a lot more than 100 grand coming back.
Exactly.
So then what do you do with this? What do you do? So I think again, you need to have more of those answers internally to start, right? That's again, why you put the sweat in friends and family. You want to have, I know this is going to be like a broken record, but we said it before, but you're going to want other people with experience with you as your founders, as your advisors or board or whatever, because they know how to navigate these kinds of challenges and they've done it before and it's not easy, right? Because I think one of the things that destroys companies that is caused somewhat about the investor relationship is that people like to be nice, right? And you and I have personally seen some of this stuff is that being nice when it obscures truths and then lets those things fester really is a bad thing, right? And so, a concrete example here, or a more illustrative example, I should say, is if you've got a misalignment about where you want to take a company, you need to know that up front with a potential investor, right? And again, VCs are very clear on this, right? They have to be, right? Seed funds, because they're funds, they have to be, actually legally, they must be clear about what their outcomes are because they're promising that to their own investors, right? Angels are not a lot of cases because they may not have had that much experience. And in that case, frankly, it's beholden on you as the entrepreneur to be like, listen, hey man, let's talk about what you want to do with this, right? Let's talk about where you're going to be happy with this.
This is how they got the name angels, right? The reason they're called angels is because they don't have the same, theoretically, they don't have the same crazy expectations, quote unquote. I'm not going to say they're crazy. They could be reasonable, but they don't have the same crazy expectations that the venture capitalists, seasoned venture capitalists might, right? And or worse, a vulture capitalist, right? Which is like the opposite of an angel. I think that it's important for people to understand, like, there's a reason why, making this progression makes sense, but your business has to reflect it as well, right?
And I think people also get confused because they'll say, hey, because my company is strong, meaning I'm already hitting my milestones, I'm generating revenue, that means we're aligned. And that's not actually the case, right? Because it's the difference here a lot of times has to do with exits. It has to do with what you're happy with, right? I like to say a lot of cases that like, I don't mind singles and doubles, right? As long as we get them quickly. You spend 10 years to get a single, right? That's not a good use necessarily of your time, which is also important, or certainly your own capital. And again, the deeper you go into the money, when you got to get that 10x or more, right? You don't want singles or doubles. You want grand slams. And you're actually perfectly happy to lose opportunities for early things versus later things. And again, when you have and this also happens between people and their partners if they're in different financial situations, right? So you're like, a partner maybe, listen, I can go back and be an investment banker. That person, I can go back and wait tables. A lot of it different, right? A little bit different in terms of what they're going to want to come out of the startup. And again, this is stuff, again, you should try to get clear as much as you can by talking it out. But really, when you put in the sweat and you ask Uncle Jimmy for money, that's when these things can really be proven.
Yeah. All right, cool. So how do we help people understand the right people that they should be talking to, right? So a lot of this comes down to, like you said, aligning interests. And I alluded to this a minute ago, with understanding and talking to the right people at the right stage for what your goals are, what your interests are. And so you're going to talk to VCs, understanding what the VC wants and needs to get out of it, and that they're not going to be, like you said, okay with you building this into a nice little company that like pays all of its employees and throws off some profits, right? So how do you find the right qualified investors you need for your company, and sort of how can you make sure that you don't end up with the wrong people in your company that are not aligned with your vision?
Yeah, obviously you can't make sure, but what you can do to be better. I think that the one thing, look, no any vulture capitalist is coming in there saying like, I rape and pillage companies, right? Like that's not what they're going to do, right? In general, maybe something, I don't know. It's a model. Look, I think that the best way to do it is by asking people who have experience or at least can talk the right language and can ask the right questions. The number one thing is, obviously, look at the companies they founded, talk to those founders. A lot of cases, they're more than happy to talk to. The problem is what's on their website is always the backwards looking history of the successful ones. So you would really need to try to dig out. And this is, again, through networking and for people who know other people can be like, oh yeah, bro, I heard that this is what happened in that boardroom discussion that came out saying that the CEO stepped down. Though getting those stories and trying to understand and digging with that is worth the energy before you go and work with a particular VC. Now, don't get me wrong, times are tough. People are going to be like, but it's never nothing. And I just want to be clear, if you're misaligned, it's already nothing. It just hasn't happened yet. Right. And then like, to be really blunt, right? So like in the worst case example, like you let the fox in the henhouse, man. So that person wrote you $1 million check, and you're signing some contract or whatever. And like, you're like, oh, but I'm protected. But like, yeah, but can you afford the lawyers to defend that? No, you can't.
Yeah.
You can. Right. So what's going to happen? Well, I'm protected. I negotiated that. You think?
Yeah.
You gotta be careful, especially if you're in a tight squeeze. And I do appreciate the fact that good revenue generating profit making companies right now are in a bit of a tight squeeze. So I just really do your diligence, talk to people, make sure you're talking the right language, lean on your advisors. And if you yourself or your team don't have the experience, get that experience to ask those questions and do it now. I know it's tough.
I think what you're saying effectively is that there's sort of two sides to due diligence, and a lot of times we think of it like, okay, like now the VC is doing their diligence and now they're going to tell us what they're going to do. And it's now you should also be doing diligence in that time frame. And you could also be looking in, talking to other founders. You could even ask for, hey, you could ask them for references. Like you ask them for, hey, do you have any founders, any other people that we can talk to? They may or may not give it. It depends on the people. But the idea here is that you're looking for that match. And to your point, if you're working with the wrong partner, it's nothing. It just hasn't happened yet. Similarly, if you are going down this road of looking for the right person, I don't think anyone who is aligned with you is going to be upset that you're doing your diligence. In fact, I think it probably only reflects well on the founder. And so I think a lot of founders probably get skittish about doing the diligence that needs to be done, when in fact, I don't think it would look negative if they did.
No, and certainly from the right people, right? But that doesn't mean like the way in which you approach it and all that kind of stuff, right? Like until the money's in the bank, the deal's not closed. So we're not saying here you should be an asshole about it. You should be like, jump up and down and be like, no, you proved to me why you're so awesome. Look, this is somebody you want to work with, right?
Yeah.
But yeah, and that being said,
you have to be careful too, right? Because everybody has these circumstances where, let's say you go and you do some due diligence on an investor, you find out like, oh, a year ago, one of the ventures that they invested in fell apart and whatever. There's always going to be startup and just ventures in general are messy. You're never going to come out with 100% of the people who've ever worked with a serious venture capitalist being like, oh yeah, he's the best guy. There's going to be occasionally a guy who thinks that people suck. And it's understanding how to interpret that data point within the context of the broader picture and understand the ways in which this person came to think that way and whatever. So I think it's important to take that with a grain of salt, trust your gut as well, incorporate that into the rest of it. And then obviously your decision and hopefully you have choices. But to your point, not always the best environment for fundraising.
Yeah, especially now. Let me bring up two quick things. One is there are no such things as VCs. Maybe this is another max. No, but what I mean by that is a VC is a partnership, right? And a partnership has some internal politics and how this works. But very often, most VCs partners have a lot of autonomy, right? While an overall firm may act a certain way, an individual partner may act a different.
Yeah.
And the people whose names aren't on the door, guess what? They want to be places where their name might be on the door. So you keep that in mind, right? So a VC is not a monolith by a long shot. Right? It is a sometimes cooperating, many times not group of partners, right? Usually kept in line by an alpha, right? That's just how and that's the person whose name's on the door, right? That's just usually how that works. So keep that in mind. Other thing is, I just want to make sure people understand that the overall theme here, raise money will last, is not about saying, oh, you should go hyper lean and starve everything, right? Again, I think we are both fans of doing things lean. And really more of that, I think it's just a philosophy that I follow anyway, but even irrespective of that, lean gives you options, right? But I just want to be clear, like don't starve your company. So again, if you're truly in a hyper growth situation, you're in a horse race situation, and you don't raise money to do the horse race, and you can't raise money to do the horse race, you can't win. So a situation where the number 2, number 3, number 4 entrant can come in and just steal your market share away if you don't make you establish your brand quickly, you have no choice but to fund a certain. Right. So please don't take our advice to be like, oh, then I need to only raise $5,000 at a time. Like entrepreneurs know that's enough.
Yeah, but
crazy.
I want to offer also, and I think you'll agree with this, but tell me if I'm wrong. It's very rare that you're truly in that situation, right?
Sure.
That happens where you're in this sort of like next best thing, and they're like, some of these AI companies, right? But the examples that I often think about and I talk about with people all the time is, look, if you have a really great idea and product is executing well on it, even if somebody is quote unquote a little bit ahead of you in your space trying to do something similar, because it's very rare that someone's doing like literally the exact same thing, that's not the same kind of horse race, right? There's a lot of factors there. Like, how big is the market? Is this something where this whole market can be actually captured by one person? Is it really that narrow of a market where 2 people are going after the exact same piece of that market, the exact same users? And, I mean, like, there's a lot of factors. It's very rare that you're like, in this true horse race, but that doesn't stop people from imagining it that way. So
yeah, no, that's a good point. I think that's a great point. I think a lot of people, think that's what they want. And now in the current funding environment, a lot of money on all levels, right? Is listen, don't be pouring this money into figuring out your marketing strategy. That's not what I'm doing here, right? I'm not going to invest in essentially lighting my money on fire while you figure out product market fit. And so you're going to hear that now. When times are better, you don't hear. You hear a lot of variants on fake it till you make it, right? And by the way, these exits happen. You can always find examples at I've had situations where a company of mine got sold to someone else who I would put more in the take it till you make it category, but they exited. Okay. Hey, everybody wins. So listen,
Right.
I'm not saying you can't do that or it doesn't work that way. I'm just saying, like you were saying, Mike, a lot of things, people like to think everything is a horse race. They like to think everything is I got to get there first. I got to pour tons of money on this before it's too late. That's really not the case. It's really more the other way around. But again, we're not talking about extremists here, right? We're open for a Goldilocks situation here. We're not saying starve to death. We're not saying fund like crazy. We're saying the normal way of thinking about this should be inverted, right? I'm saying, look, think about what you're contributing to the company before you start thinking about other people's money. Again, because most of the ethos is the other way around, right? Look, I think this starts to touch on a bit of the topic of failure. And hey, man, again, one which got brought up earlier, like why would someone back someone who's not themselves if the founder is not committing and making strong commitments? Why would you expect someone else to make commitments? That's one thing. But the other thing is that, hey, like what is the outcome, that you expect out of your time, energy, and money? What is the outcome that is expected from the the money and advice or whatever of those outsiders, and understand that like you don't really want to skimp on either. If that makes any sense.
Yeah, and I mean, if you're one of those people who really thinks that you're building the next unicorn as well, it's also important to keep in mind, like all of those unicorn founders who came before you, who often built, especially if you're talking about tech or especially software, but even tech, hard tech in general. You go back to look at these guys and they started off very humbly and they focused on building a really great product and tailoring it to the market that they were trying to sell it into. And then eventually later diversified. Like Google was not the first search engine. Before Facebook was MySpace, and before that was AOL. You could argue had a lot of the same functionality. There's incremental innovations that that have happened that ultimately lead to something that all becomes a unicorn. And so it's very rare that you're not launching a unicorn without also standing on the shoulders of giants that came before you. And so I think that it's important for people to remember being this first to market thing, this sort of sense of urgency around it, rather than doing it the best, which is what Google as a search engine, right? They're the best search engine. And they had some market differences with a lot of their competitors at the time, but they were late, right? And then eventually they diversified a business that became what we know today as Google or Alphabet, right? I just think it's important to keep those things in perspective. Mark Zuckerberg didn't launch Facebook as it exists today with a million, even the first iterations of it were not launched with millions of dollars. It was something that a bunch of kids did, right? Yeah, there was money involved, but you know, we're not talking about big money. Anyway, cool. All right. I think the last point here is if we're going to talk about fundraising, we also have to talk about, I guess, we've talked about a little bit about how you do it wrong and sort of some misconceptions, things like that. Do you have any advice on how to do it right? And is this a matter of conveying your value prop effectively? Is it a matter of knowing the right people? I think there's a combination of things here. Is there any sort of high level advice? And this is a super loaded topic that, you know, you could do in order to attract the right investors for your company? Like the most ridiculous.
We're crazy. Not even one more conversation. That's 10 more conversations, right? I meant for everybody else. But honestly, I think it's the same thing, and maybe perhaps the whole theme of doing these podcasts in the first place, which is that you just got to be brutally honest with yourself, right? Stop saying that you're special and think about why you really are special. If you're not special at all, that actually may be fine, but you got to be like, I'm not special. I don't care if this is a Me Too model. I'm just going to try to grab as much as I can. Yeah, that might be fine. That might be totally fine, right? There are entire businesses. I think people who are billionaires who do that, right? Yeah, that's fine too. You just, but if you confuse yourself either as the founder or part of the founding team or together with the early money, and you get confused about these kinds of things, that's where you run into trouble. But that in terms of advice, look, it's again, the days, if they even ever existed, and I think maybe they did in like Web 1.0 days of, hey, I'm going to come up with a PowerPoint, I'm going to get a $10 million valuation for $1 million, ever existed. They certainly don't exist now. I think in this day and age, there's just so much progress that you can make with no code platforms and all this kind of stuff in terms of so much generative AI, in terms of doing market research, in terms of outreach. It's so easy. Just do it, right? And get that start with support. So much support. But again, I think the precious commodity that's harder to get is real experience, because that's perhaps the one thing. There's a lot of advice, including this one, so take it for what it's worth, from things that are free. So it's hey man, what is all that worth? So I guess what I would say, there is no secret sauce, but like it certainly starts with being really blunt and honest and talking with people who've done it before, right? Again, that's just like repeat on that message, because I think it's critical for people to be able to have those conversations with themselves and with people that are going to give them straight up answers before you go and test that in the marketplace.
Yeah. And it's interesting because I would add that, so from our perspective, right? So when we look at founders who are probably pretty early stage for most investors at this point, we're looking at founders to work with, or we're looking at building our own teams around our own products. Like we take a pretty team-centered approach around looking at what's going to set this up for success, right? And we can be pretty hard on ourselves and around the people around us on those things, right?
Mm-hmm.
Can you guys hear my background?
Yeah.
Yeah.
Whatever. Just crank this. I got to go anyway. So
Just on that last point, why don't you guys do a wrap up and we'll just cut that out?
Okay.
Yeah.
I'm not sure that we're done yet.
What? Background?
Yes.
Anyway, or I'll do the wrap up
right.
then. Because you can,
Give me 1 second and let me convey the importance of this situation.
yeah, good luck.
Yeah, somebody else has other priorities.
Yeah, man, I'm not sure they're gonna be listening.
I remember those days. How are your kids doing?
Yeah, they're high school now, right? Yeah.
Mine are 24 and 27 and live out in Denver.
Yeah. That's cool for you.
Yeah. This is making me business. Anyway, I think I'm at the
There
level.
you go.
There we go.
Okay.
All right. Let's wrap up and go.
Yeah, just conclusions. All right, Ted, thanks for being with us today. I hope that the listeners were able to get a little bit of wisdom out of this and make some insight into the way we think and the way that they might approach their early stage funding. I know that there's a lot to talk about here. We're looking forward to everybody's feedback. You guys have any questions, definitely reach out, let us know, and we can try to address them in future editions of this podcast. Ted, is there anything else you want to add for everybody?
No, that's great. I hope this was helpful to people. Also, again, we will be looking for guests going forward. So if you're someone that wants to come in with some examples here or just wants to talk about some different topics with us, drop us a line.
Yeah. We'd definitely love to get you guys on the list. So reach out. All right. Thanks. Talk soon.
Take care, everybody. All right, cool.